So as more individual investors come into the market and buy up growth stocks, should you follow the crowd? Let's bring in David Spika, president of Guidestone Capital Management, and Ron Insana. He's a CNBC senior analyst and co-CEO of Contrast Capital Partners. David, let me begin with you. I think the answer to the question we posed in the intro there, for you at least, is no. You say equities are too rich given the EPS estimate declines and the declines that you see ahead, more downside coming. Midst of the largest decline in M2 or money supply history and the fact that the Fed policy acts with a lag, we expect a U.S. recession in the second half of the year. So what should I do?
Bonds are a great place to be right now, Tyler. We've got yields we haven't seen since the mid-2000s, since the aughts, and it's a great place to be. Now, when the Fed was flooding the market with liquidity, we had to go out on the risk curve. We had to own equities because you couldn't make money in the safer parts of the market. But today, with the Fed sucking all that liquidity back out, taking M2 out of the market, bonds are very attractive. All that said, I do think growth stocks are due for a rebound given their underperformance last year. Growth stocks are going to perform better when interest rates are stable to falling, which will happen as the market starts to price in the recession. And they also tend to do better in slowing economic times because investors tend to pay up for growth when growth becomes scarce. So for a barbell strategy, own some growth equities and own some short-term bonds. I think you're in good shape. And
so growth, even though you say more downside is ahead.
Well, we're long-term investors, Tyler. I'm not going to try and tell anybody don't time the market. We're in the midst of a 16% rally right now that I would not have predicted. Inflation's still very hot. The Fed still has their pedal to the metal. The market has not priced in what will be much lower earnings. And so when you bail out of the market, you're going to miss those bear market rallies. So I think you need to have equity exposure, but you want to be invested in high-quality companies that can withstand a high inflationary environment and that will benefit from the trends we're seeing right now.
Ron, what do you think of what David just said?
Yeah, I think we're close. I mean, I would go more specifically towards, just stock selection based on not just the recession resistance and inflation resistance, but just really focusing in on high quality. I do agree, although at the very, very short end of the Treasury spectrum, that people should be playing there. When you've got the 6-month bill and the 1-year bill now yielding more than 5%, that's pretty much a steal at this point. And so that seems like a safe place to park funds. I just think the market's going to be extremely choppy. I don't see any real direction over the next several months that's meaningful. And again, as we've discussed many times over the last several months, you do not get a secular bull market in stocks while the Federal Reserve is still tightening policy.
So speaking of that, what are your thoughts on the latest we're hearing from Fed officials, Ron? Because we have now a couple of them calling for maybe going 50 if they were voting members. Bank of America just changed its forecast for June from a pause to a 25 basis point rate hike, and the market seems to be going along with that.
Yeah, I'm in favor of duct tape in this environment. I wish we could get some people to stop speaking about changing their minds literally on a weekly basis, whether it's Jim Bullard, Larry Summers, or whomever we've spoken about in the past. Now we've got Larry saying that, the Fed's going to hit the brakes really, really hard. Then 2 weeks ago, he was saying we could have a Wile E. Coyote moment. Then the week before that, it was inflation was going to accelerate. I think there are a lot of officials and ex-officials who are speaking far too much in an environment that I don't think we know quite enough about. I think and I'll admit that I was wrong to an extent on inflation insofar as it's stickier in shelter, it's stickier in services than we thought, even though it's decelerating mildly, not coming down fast enough. So I think everybody's putting a finger in the wind and making comments that probably don't make sense in this environment.